Let's talk about one of the most powerful concepts in investing. We'll explore this idea using real-world examples from Kenya, the United States, and the United Kingdom. But first, let me ask you, have you ever thought about your money earning its own salary? Imagine a stream of income that flows into your account year after year without you having to lift a finger. It's not a fantasy, it's the reality for millions of investors around the world. This is the magic of dividends. It's the art of making your money work for you, instead of you always working for your money. Today, I'm going to break down dividend investing in the simplest way possible. We'll look at what dividends are, why companies pay them, and how you can understand them, using familiar companies from the Nairobi, London, and New York stock exchanges. So what exactly is a dividend? At its core, a dividend is a way for a company to share a portion of its profits with the people who own it. And who owns a public company? Its shareholders. When you buy a share, you're not just buying a piece of paper or a digital entry. You're buying a tiny piece of the business itself. If you own a share in that company, you are entitled to a slice of its profits. Think of it this way. You've become a silent partner in the business. You provide the capital by buying shares, but you don't have to manage the day-to-day operations. When the business succeeds and makes money, you get your cut as a thank you for your investment and trust. Let's make it even simpler. Imagine you and two friends start a small coffee shop. At the end of the year, after paying for rent, beans, and staff, you have a healthy profit. Now you have a choice. You could reinvest all that money back into the business, maybe buy a bigger espresso machine to serve more customers. Or you could decide to take some of that profit and split it amongst the three of you as a reward. That cash payout you give yourselves? That's exactly what a dividend is on a much larger scale. So why do companies do this? Firstly, to reward their loyal investors. Consistent dividends keep shareholders happy and encourage them to hold their shares for the long term, which creates stability. Secondly, to attract new investors. A reliable dividend payment is especially appealing to people looking for a steady income stream, making the company's shares attractive to a wider audience. And thirdly, it's a powerful signal of financial strength. A company that can consistently pay dividends is telling the world, we are profitable, stable, and confident about our future. In Kenya, a classic example is Safaricom. Thanks to its massive subscriber base and services like M-Pesa, that generate consistent, reliable cash flow, it's well known for paying substantial dividends to its shareholders. In the US, a company like Coca-Cola is a dividend aristocrat, having increased its dividend for over 50 consecutive years. Its global brand ensures steady sales and profits, funding those reliable payouts. And in the UK, a company like Unilever, which owns brands people buy every day, generates the kind of predictable revenue that allows it to be a consistent dividend payer for its investors. Now, to compare these opportunities, you need to understand one of the most important concepts: dividend yield. Think of it like the interest rate on your savings account, but for shares. It tells you how much cash flow you're getting back for every dollar, shilling, or pound you invest. The formula is simple. You take the annual dividend paid per share and divide it by the price of a single share. For example, if a share costs $100 and it pays a total of $5 in dividends over the year, your dividend yield is 5%. This metric is crucial because it allows you to compare the income potential of different stocks on an apples-to-apples basis. However, a word of caution: a very high yield isn't always a good thing. It can sometimes be a warning sign that the company is in trouble and its stock price has fallen. Always look at the health of the business, not just the yield. Let's break down exactly what dividend yield means. In simple terms, it's the annual dividend per share divided by the share's current price. So, if a stock has a 5% yield, what does that really mean for your wallet? It means that for every $100 you invest in that company's stock, you can expect to receive $5 in cash dividends over the course of a year. Think of it as the immediate return on your investment, paid out in cash, just for holding the stock. It's a powerful metric because it allows you to compare the income-generating potential of different companies on an equal footing, regardless of their individual share prices. Let's bring this to life with some real-world examples, starting in Kenya. Take Safaricom, a titan of the Kenyan economy. If its stock is trading at 20 Kenya shillings per share and it pays an annual dividend of 1 shilling per share, the calculation is simple. 1 divided by 20 gives you 0.05, or a 5% yield. So for every 20 shillings you invest, you'd get 1 shilling back each year. A 5% yield from a market-leading company like this is often considered quite attractive by local and international investors alike. Now let's hop over to the UK. Consider Unilever, a global consumer goods giant whose products are likely in your home right now. This stability often translates into consistent dividend payments. If Unilever trades on the London Stock Exchange for £40 per share and pays out £1.60 in total annual dividends, that's a 4% yield. A £400 investment would therefore generate £16 in cash each year. For many income-focused investors, a 4% yield from such a well-established defensive company is a very solid proposition. And across the Atlantic in the US, we have companies like Coca-Cola. If its stock trades at $60 and it pays an annual dividend of $1.80, the yield is 3%. This means a $600 investment would return $18 a year. Now, 3% might seem lower than our other examples, but there's a deeper story here. Coca-Cola is a world-famous dividend king, a prestigious title for companies that have increased their dividend for over 50 consecutive years. This incredible track record of its dividend is a testament to its financial strength and is often more important to long-term investors than a high yield today. However, it's crucial to understand that not all high yields are created equal. In fact, an unusually high yield can be a major red flag, a potential dividend trap. Why? Remember, the yield is calculated using the share price. If a company's stock price has fallen dramatically, the yield will mathematically shoot up, even if the dividend payment hasn't changed. This price drop is often happening for a good reason. The company might be in serious trouble. Perhaps its sales are plummeting, it's losing market share to a competitor, or it's buried under a mountain of debt. Investors are selling the stock because they fear the company won't be able to afford its dividend in the future. A 12% yield might look tempting, but it's worthless if the company cuts the dividend to zero next quarter and the stock price continues to fall. So what's a healthy range? While it's not a strict rule, sustainable dividend yields for stable, mature companies often fall somewhere between 2 and 6%. This range typically represents a sweet spot. The company is profitable enough to generously reward its shareholders, but it's also retaining enough of its earnings to reinvest in research, development, and growth. To dig deeper, savvy investors look at the payout ratio, the percentage of a company's profits that it pays out as dividends. If a company is paying out 90% or 100% of its profits, it leaves no room for error if business slows down, putting that dividend at high risk. This brings us to the seesaw relationship between share price and yield. They move in opposite directions. Let's imagine you buy a stock at $100 per share and it pays a $5 annual dividend. Your yield on that purchase is 5%. Now, if the company does well and the stock price rises to $200, that $5 dividend payment is still the same. But for an investor buying at $200, their yield is now only 2.5%. Conversely, if the stock price falls to $50, that same $5 dividend now represents a huge 10% yield for a new buyer, though as we just discussed, you'd need to investigate the price fell so much. Please remember, all the companies and figures mentioned are for educational and illustrative purposes only. They are not recommendations to buy or sell. I am not a financial advisor, and it's essential to do your own thorough research or consult with a qualified professional before making any investment decisions. So, with the mechanics and risks covered, let's focus on the powerful advantages of dividend investing. First and foremost is passive income. Dividend payments are real cash deposited directly into your brokerage account, usually every 3 months. This creates a predictable income stream that you receive simply for owning a piece of the company. You can use this cash to pay bills, supplement your salary, or, for maximum effect, put it to work through reinvestment. Second, dividends provide stability. During turbulent market periods when stock prices are fluctuating wildly, The regular arrival of a dividend payment is a comforting reminder of the company's underlying financial strength. This income can help offset paper losses in your portfolio, making it psychologically easier to stay the course and avoid selling at the worst possible time. Finally, and perhaps most importantly, is the power of long-term wealth creation through compounding. When you reinvest your dividends, you use that cash to buy more shares. Those new shares then start earning their own dividends. This creates a virtuous cycle where your investment snowballs over time. Albert Einstein supposedly called compound interest the eighth wonder of the world, and reinvesting dividends is one of the best ways to harness its incredible power for your financial future. But before you dive in, it's crucial to understand the risks. First, dividends aren't guaranteed. During tough economic times, or if a company underperforms, it might cut or suspend its dividend to preserve cash. We saw this with many companies during the 2008 financial crisis, and even giants like General Electric have had to slash their once reliable payouts. Second, not all great companies pay dividends. Many growth-focused businesses, particularly in the tech sector like Amazon or Tesla, choose to reinvest all their profits back into the company. They focus on research and expansion, aiming to deliver returns through a rising stock price instead of regular income. Finally, be wary of chasing extremely high yields. This can be a dividend trap. An unusually high yield often signals that the stock price has fallen dramatically because investors are worried the company can't sustain its payments. It looks tempting, but it could be a sign of underlying trouble. So, how can a beginner get started on this journey? The first step is to open a brokerage account. Choose a reputable platform that suits your needs, considering factors like fees, ease of use, and the markets it offers. For our viewers in Kenya, you can explore user-friendly platforms like the HISA app, or work with established brokers on the Nairobi Securities Exchange to invest in local dividend-paying giants like Safaricom or KCB Group. For those investing globally, platforms like eToro and Interactive Brokers offer access to a wide range of international stocks. In the US, you might consider brokers like Charles Schwab, while in the UK, platforms like Hargreaves Lansdown are popular choices. Once your account is set up, the research begins. Look for stable, well-established businesses with a long history of paying and ideally increasing their dividends. In the US, these are often called dividend aristocrats, companies like Coca-Cola or Johnson & Johnson that have raised their dividends for over 25 consecutive years. Also, check a company's payout ratio to ensure it's not paying out more than it earns. And crucially, diversify. Spreading your investments across different companies and sectors, like healthcare, consumer goods, and utilities, protects your income stream if one area faces a downturn. Ultimately, dividend investing is a powerful strategy for building wealth over the long term. It's about making your money work for you, generating a passive income stream that can grow even while you sleep. Consider the power of reinvesting those dividends to buy more shares, which in turn generate more dividends, a process called compounding. Remember, the goal isn't a get-rich-quick scheme by chasing the highest, riskiest yields. It's about patiently building a portfolio of quality companies that can provide you with a reliable and growing income for years to come. If you found this guide helpful, please show your support by hitting the like button, subscribing to the channel, and sharing with friends. Join me next time for more Money Matters tips from around the world.